Good evening, greetings Year 12 students. Here we are again with another video lesson. Today we're going to look at home loans. This ties in with the assignment that you guys are doing at the moment. So let's have a look at the task sheet. Here it is. Now in class we've worked on this a bit already, but I just thought I'd go over the bit about generating the spreadsheet. So how to construct the spreadsheet, and the aim here is to show you, I guess, the nuances of using formulas in Excel and how to generate those formulas over many cells. So we'll cover task 1 part C, and if we get time we might do some of these other things in here, like construct the plot and then look at monthly interest as a percentage of monthly repayment. Okay, so let's get this out of the way here. So let's kick it off with looking at some basic theory here. So this is the present value annuity model right here. And so this model is very similar to, this formula here is very similar to the compound interest formula. The only difference is we've added in an extra parameter, and that is R, the repayment. So it's a periodic amount that's paid into it's contributing towards paying off a loan amount, and you can see the graph here represents how that amount that is owing, it's called the present value, how it diminishes over time, and it diminishes through the regular installments or repayments. But the thing this graph here doesn't show you, of course, is the interest that is added along the way. Okay, so the two main variables here are A, which is the present value of the annuity, and N, which is the term of the annuity, or how many months to go. So if we pick any point on the curve here, say point over here, we can say, well, the present value of the loan here would be whatever the value is. If we interpolate across to here, we get some value. So we'd say the present value is such and such, and then the N would not be how many months or years have passed, but how many there are to go. So the amount here, right? So the variable A is a function of how many terms to go. Okay, so when we get to the bottom here, when A becomes 0, then N would then be 0. Okay, so you can see at the start, if it's a 25-year loan, we could say there's 25 years to go. So you'd say you owe the maximum amount, whatever you start with, that's what you owe with 25 years to go. Okay, so while we're here on this page, let's briefly look at some of the assumptions with such a model. It is quite a blunt instrument in the sense that it's only giving us an approximation for what the repayments are going to look like over time. There's a few things that we can't know into the future, and one of those is the interest rate. So the big assumption, I guess, is that we fix the interest rate. So if it's a 25-year loan, we're going to say it's fixed for 25 years. In practice, that never happens. Loans generally are only fixed for a couple of years, and then they're renegotiated at the end of that couple of years, and they're renegotiated in the context of what the cash rate is at the time. So the cash rate can move up or down at any time depending on economic influences. At the moment, the cash rate is quite low, and hence interest rates are quite low. So the expectation would be that over time, starting from now, over a 25-year period, we'd expect that probably those interest rates would go up. But who can tell? I mean, the economy is pretty stagnant, has been for the last few years, could be for a few years into the future. So anyway, it gives us an idea of what's going to happen if we just put in an interest rate fixed. Some of the other assumptions here, so only the minimum monthly repayment is made throughout the term of the loan. So up in this formula here, obviously, to work out the present value based on how many months there are to go, we need to have a fixed rate, but we also need to have a fixed repayment. Now, when you sign up for a loan, the bank manager will obviously tell you what that repayment's going to be, but it's only a minimum repayment. It's not the repayment that you have to stick to, but it is the minimum that you should make. Now in practice, you would always attempt to pay more than the minimum. The advantage being that you pay the loan off sooner and you pay less interest in the long run. So we're assuming that only the minimum monthly repayment is made throughout the term of the loan. And the third assumption, which is a less obvious one, and that is that the interest will be compounded on a monthly basis. So over here we're going to construct a spreadsheet model showing present value interest repayment month to month over a 25-year period, and we're assuming that interest will be compounded on a monthly basis. In practice, banks actually compound interest on a daily basis, even though the interest that they charge to you is done so on a monthly basis. So what that means essentially is if you check your bank statement with regard to your loan, it would show you a monthly charge that will pop up, once a month at the same time every month. But what it doesn't show you is that amount of interest is actually calculated based on a daily compounding rate. Okay. Now, in the end, it turns out that compounding daily versus compounding monthly doesn't make too much of a difference, although it does favour the bank. The more often money is compounded, the more money that the bank will make that way. Good. So that's looking at this model here that will be at the heart of our calculations here in the spreadsheet. We've got the assumptions of the model, and now here's the model down here again, just rearranged so that we make R the subject, okay? Because generally what happens with a loan is you'll have some amount that you borrow, there'll be an interest rate that the banks will quote to you, and then based on that amount that you borrow and the interest rate and the term, the 25 years for us, we can work out the repayment. Okay, so we're going to have to use that formula. In fact, that is one of the early steps in task 1 of the assignment. I think it's part B here, calculate the monthly repayment. So we'll just do it now in Excel. We'll do it in a minute in Excel. Before we do any of that, of course, I will just open up a website here. This is a little app. I know working with some of you've seen me use this already. So here's a scenario that I've created here. So borrowing $450,000 from a bank over 25 years, and it says variable here, but this is constructed with the assumption that rate is the same all the way through. So the rate I've got here is 4.84. Where did I get that from? I just Googled Suncorp home loan rate, and you can see here there's the rate of 4.84. It's fixed over 5 years. I could do the one for 1 year. It doesn't really matter. We're just getting a rough idea at this stage, okay? I think it would be safe to say interest rates for home loans are anywhere between 4 and 5%, based on a loan-to-value ratio of 80% or less, which means you want a deposit of more than 20%. Okay, so here we are. So looking at this little app here, we can see that the repayment's been calculated for us, and it's even given us a graph similar to the one we were just looking at, showing how the present value diminishes over time, over the 25 years. This other graph here also shows how what you owe diminishes over time, but it projects what you owe to be not just the present value, but the total interest that you're going to pay over the course of that loan. Okay, so quite interestingly, you can just get a quick snapshot here, and you can see that if you're borrowing $450, the total interest that you pay on that is somewhere in the realms of $327,000, which is significant. So of course we could reduce that amount by paying the loan off sooner by making bigger repayments. All right, let's get underway. So using these same numbers here in the spreadsheet, let's go for it. So you can see I've set it up here already. So this little area over here is where we're going to enter our parameters and our variables. So we'll start with 450,000 for the amount that we're going to borrow. The rate, we said that was 4.84, so the rate is going to be 4.84. So the term will be 25 years, and the repayment. We'll get to that in a second. So what's important, because we're doing the spreadsheet on a monthly basis, we need to work out what the interest rate is monthly, but we also need to work out the number of months over 25 years. So they're just some simple formulas in here. What we can do here is maybe use the percentage mode here. No, actually I won't do that. That's a bit annoying. I'm just going to, sometimes that works easily. It didn't work for me now. So I'm just going to convert it back to just a general mode. And what I can do, actually, I think if I type in percentage, that might be the thing to do. There we go. So it says 4.84%. Now, if I want a monthly rate, I'm just going to divide that by 12. And there it is. And that's been rounded. And I can probably know that if I expand that, the width of that cell a bit, yeah. So you can see it's, looking at that there, it's probably about 0.004. Yeah. Look, I'm pretty sure that's right. I'll check it in a minute. In fact, I can just do it here. If I just do 4.84 divided by 1200, so it's dividing by 12, but also dividing by 100 because we convert percentages to decimal fractions. So yeah, it is right. Okay, good. Now this thing here, that's just going to be equal to the 25 years times by the 12, and we've got months. So I'm just going to highlight these particular values here because they're the ones that we need to use in this formula here for repayment. Now going back to, I had it, not that one, get rid of that, bring that down. Oh, that was it. What am I doing? So looking at this formula here, that's the one we need to type in here. Okay, so let's see. Repayment equals A, the amount that you borrowed at the start, times by the rate, I, divided by, and then this whole denominator here in brackets, so it's going to be 1 minus 1 plus the rate, close brackets, raised to the power of negative n, which is 300, close brackets, and there we are. So we've got our repayment. Now I'm going to convert that into currency mode, and similarly this one here as well. And we can see, if we go back to our repayment calculator here from the bank website, if we compare our repayment to the one they've got, you can see it's pretty much the same. So that's good. So we know we're on the right track. Okay, so now for the spreadsheet. First thing is, let's get a column of months. So we need to take this up to 300. So we're going to take that for a little walk down the page until we get to 300. And there we are. So about there, good. Now, the present value. So this is a month-by-month analysis. So we're just, in this first row here, we're looking at what's happening in the first month. So the present value is basically what we owe at the start, okay? That's that. The interest. Now note, what I'm doing here is I'm going to set up a bunch of formulas. Once I get those formulas done in the first couple of rows, I can drag them down and it will fill out the whole spreadsheet very quickly and very easily. What's important though is that we don't type numbers in here, just type in cell references from over here. That is because at any time, if we decide to reuse this spreadsheet with different parameters here, all we need to do is change the parameters here, and because what's set up over here pulls off of here, it means we don't have to change anything in here. This should change automatically. The only thing we would have to change over here, of course, is if the term changed. So if we went to 20 years or 30 years, we're obviously going to have to stretch the spreadsheet to more cells or bring it back to less. Okay, so our first formula, you can see it's just pulling straight off there. Interest, so this is just a simple interest or percentage calculation here. So the present value times by that monthly interest rate, done. The hashes, don't worry about that. That just means we need to widen the cell. The repayment, we're going to pull that straight off here. And the balance, so the balance is basically what we owe at the end of the first month. So at the start of the first month, it's 450,000. This interest gets added, okay, so that's the bank interest, so we have to add that. and then the repayment is what we contribute to bring that balance, to bring that present value down. So the balance is essentially just that number there, the present value plus the interest minus the repayment, and there we go. And you can see that's there. And then over here, we can now start looking at the second month. So in the second month, we can just drag that balance or pull that balance at the end of the first month over to here. So that goes there. And it's pretty much ready to go. There is a couple of things I need to fix up in here though. So let's just quickly go through those. If you look at the interest formula here, what it will do when I drag this formula down is it will take this rate and multiply it by whatever the present value is, okay? Now when I drag this formula down, these cell numbers will change. So it will go from H4 to H5 to H6, H7, etc. And the same for the E's. Now, we do want the H reference to change because obviously as we move down, the present value is changing. So we want that to change. This, however, we don't want to change. So E6 is referring to the monthly interest rate. We need that to be a fixed value. So we need to fix this part of the formula to that cell. Okay, so the way we do that is we use a dollar symbol in between the letter and the number there, and so that'll do the job. So if I drag that down once, and then we look at that formula, you can see H5. So the H part has moved down one, but the E6 is still referring to that there. Okay, if you don't put that dollar symbol in there, you'll soon know because you'll get some nonsense in here, which means it'll be pulling from cells in this area, and it'll start pulling nothing, and yeah, you'll get nonsense. So that's right. And you can see the interest has changed just moderately. It's a little bit less. It should be because what you owe is a little bit less. So over time, we're gonna notice that the interest amount in dollars will reduce. Now the repayment is a similar thing because the repayment is going to be the same throughout. It's a constant, amount of money that's paid every month. We want that to be a constant, so we need to fix that with a dollar symbol as well. And then if we drag that down one, you'll see that is that. Okay, that should be the same. And the balance formula, well, we don't fix anything in there because the balance relies on these changing amounts all the time, although this one doesn't change, of course. So let's just drag that down one. And then what we have, if I just do this thing where I hit Control tilde, I can see the formulas that are behind each of those values. And it's actually a good idea when you present your spreadsheet in your final report is to maybe just get a screenshot of some of these formulas just to justify the work that you've done. Okay, so we can see that's that. I'm going to go back to here. Now, all the formulas that we need to use are in that second row. We already have a column for N up to 300. Now, because these columns here are adjacent to that one that's already complete, I don't need to literally drag this down like that. All I need to do is get my cursor in that place there, the bottom right-hand corner, where I see the solid cross there, and I just double-click, and then it will automatically generate everything we need. Okay, so let's go down and check that it's fine, and we know it's fine if we get a balance of 0 at the end of 300, and we do indeed get that, so that's all good. Okay, excellent. Now we can just have a quick look here and just observe a few things. So obviously the repayment is the same all the way through. By the way, we don't even need to put the repayment into this spreadsheet because it is a fixed amount. I just like to have it there because it shows you what you owe, what gets added to what you owe, but then what gets taken away from what you owe, okay, on a month-by-month basis, okay? And what you'll notice, so you can see the interest amount drops over time. This stays the same. The balance drops and the present value drops. Now, you'll notice that the present value and the balance are really the same thing. They're just out of sync by 1 month, okay? So these two columns here, H and K, are essentially saying the same thing in a way. Right, this is good. Now, what we'll do is just over here, we'll just add a couple of calculations here. So I'm interested in knowing how much interest in total is paid over the course of that loan. So in other words, what is the total of all the values in this column here, and that will give me a total of all the money that the bank has made in this annuity. Also, we'll get the total repaid, so in other words, the total amount of repayments over the 300 months. So we can do it a couple of ways. I'm just going to go SUM of this column here, and if we use Control Shift down, I think I'm on a Mac here, so I'm going to have to do Command Shift down, Enter, and there it is. So you can see that's the sum of that column. And then in here, repaid, I could do a similar thing here where I just do the sum of all those, or I could just recognise that this is a fixed amount. There's 300 of those in there, so I'm really just doing the repayment times 300. Whoops, don't want to do that bit there. Okay, there we go. So I'm just going to put borders around these and these two here as well. And so what we'll notice is, looking here, you can see it's a bit of a summary. This is what you pay back in total over 25 years, so 776,000. And do observe that if we come back to this original calculation here, you can see that's the same, 776,663. Okay, so that checks out. That's the interest that's paid, and that's what you borrowed initially. So what you borrowed initially plus the interest you paid is what you pay back in total. So it's not quite 50%, right? But it's significant. In fact, if we just do a quick ratio calculation here. So what proportion is the interest of the repayment? You can see it's 42%. So what that's saying is essentially your interest as a proportion of your repayments over the whole term of the loan is about 42%. Interesting. What happens is when the interest rate is higher, then the amount of interest you pay will increase, and if it's a big enough mortgage, that proportion of interest to repayment can sometimes exceed 50%, which means essentially you pay more interest than what you borrowed in the first place. So that's interesting. You think, well, why would you do this? Why would you embark on borrowing that much money to pay that much back? Well, I guess the point is that over time, particularly over 25 years, you would expect property values to go up. So if you're borrowing $450,000 to, say, buy a $600,000 property or something like that, you would expect that $600,000 property would be worth quite a lot more after 25 years. You'd hope so anyway. Okay, so there is an element of risk in property, but it's considered to be quite low compared to other forms of investment, such as investing in the stock market. All right, a couple of other things we'll do here. So let's say that we're going to look at this, from the perspective of, actually what we pay back in total is the interest plus what we borrow, so that's 776,000. So if we start with that amount, so we can do that here. If we start with that amount, and then we diminish that over time, by the repayment. So what I'm going to do here is just put a little formula in, which is this cell here above, right, which is the present value plus the interest. In the next month will equal that amount minus the repayment. Okay, now that formula, we can just drag that down all the way. I could have double clicked, of course. Take it all the way. And you'll notice we get to there, it's not 0, but it's one repayment off 0. That's because it's just out of sync by 1. If we drag it down one more, whoops, that didn't work. Hang on. I'll get this right. Interesting. I know what the problem is. Okay, that's a bit silly. So what we could do here is we could just say this, not that, minus that. Yeah, we get it to 0. Okay, there we go. So, so that run of data there is it's a linear it's a linear progression, if you like, and if we graphed it, it would be that thing there, right? Whereas this run of data here is exponential. So this decreases exponentially, this decreases linearly. This is, what you owe at any one time. This is a projected amount that you would owe at any one time. Of course, if you're paying more, it might be the case that, halfway through the loan, 100, well, we're looking at 150 maybe. It's a 25-year loan. It's 300, yeah. So somewhere around the 12, 13-year mark, we might think, okay, we're owing about 300,000. You might, get a windfall of money. It might be an inheritance or something. You might get $150,000, and you decide, okay, I've got this debt of 300,000. I want to knock it down hard. So you slap 150 on it just then and there, and so in 1 month it will go from 300,000 to 150,000. So, and then suddenly the interest that you pay on that will drop dramatically. Okay, which means overall you'll pay less interest. And then this thing here is then not a true guide as to what you owe, because this is based on the interest that you would pay if you paid the minimum monthly repayment and if the interest rate was fixed. So, okay. Last thing I want to do here is just do the graph. We'll do a couple of graphs for this. So let's start with this one here. So I'm going to do present value over time. Okay, so highlight that, charts, scatter. Okay, there it is. Now that's quite a small graph. I want to see that, from a bigger perspective. So I'm going to put it in its own sheet. And the way we do that is we right-click on some white space up here, right-click, move chart into its own sheet. Now I'll call this task 1. It's a 25-year loan plot, whatever you want to call it. Okay, and there it is. Okay, now we can add to that. In fact, we'll add to that. So we're going to put in the linear one with the present value plus interest. So we select data. This first series here, we'll just call that present value. This is present value only. Now we're going to add another series here. We'll call this one present value. I'll just use PV plus interest. Okay, and then, so the X values is N, the time, the 25 years or the 300 months. I can leave that blank. If I leave it blank, it will automatically work off the other series, this present value series. So I'm just going to put in the cell values for the Y values, which is, come over here, that is this column here. Okay, all right, it won't let me do Command Shift down, so I'm just going to highlight it like this. Now it's important, because we're doing it for 300 months, we don't go all the way to 0, we just go to there. Did I go to 0? I did, didn't I? So I'm just going to knock that back to 303. There it is, done. The only thing left to do here is obviously put in our labels. So, where do I do that here? Chart layout, titles, horizontal axis. This will be term in months. This will be, we'll just say it's present value in dollars. I know it's present value. There's 2 series there, but that's present value. So yeah, we've got 2 series here. The legend here tells us which is which, and then a title, of course, wouldn't go astray, would it? So we'll call this a 25-year term. Don't know what I'm doing. Annuity. And there we have it. So there's our graph and there's our spreadsheet. And if we want to provide evidence of what we've done there in that spreadsheet in our final report, we might do something like this. We might just get a snapshot of this loan here. Okay, so we'll do that. So maybe the first 10 months or something like that. Here we go, Control C, go over to our Word document here, and I'm just going to do a paste special where I'll do picture. Okay, and that way I can just fit it in nicely there. Now, I can't really see that very well. If I zoom in, that's a bit better. So that gives us an idea. Obviously, I want to say something like, this is a 25-year loan annuity. And then we could probably add to that just a second snapshot of just what happens at the end. Okay, so maybe the last 10 or something. Yeah, well, Control C. And paste special, of course, paste this picture. And there it is, and still hard to see that, but I think you get the idea. You can see it quite well there. So this shows you the first 10 months, the last 10. You can see how the balance goes to zero over that time. You can see the repayment is the same. You can see how the interest changes. Yeah, and then under that, of course, we could include the plot, couldn't we? So we just get a copy of this. Copy, yeah. Here I am showing you how to cut and paste. I think most of us are pretty good at that. I'd hope so anyway. That didn't work for me for some reason, but it did. Just took a while to process. Okay, all right, so that's a very rough idea of what we're doing anyway. I think that's it. The only other thing I can think of actually is with the assignment, where is it? This one here, isn't it? Part E, where we have to look at the monthly interest as a percentage of monthly repayment for the first year, the 12th year, and the 25th year. I did it for the whole loan. Yeah, I just did the amount of interest paid overall as a percentage of the total repaid. We need to do that for maybe the first 12 months. So we could do year one, same thing. So how much interest is paid in the first year? Well, we just add up all of those values there and then divide that by the sum of the repayments in the first year. And there we go, and that's about 69%. And so you can see overall it's 42, but in the first year it's 69%. So what we can see there is what you pay back, 69% of that is just covering the interest. Okay, overall it's 42. If you look at the last year, you can see the interest being paid is $100 or less. So that's a much smaller percentage of the repayment. So that should be a prompt to answer the question, or to comment, I should say, to comment on the assertion that at the beginning of the loan, most of the repayment covers interest. Okay, so that shows you 69% of, in this particular scenario, 69% of the repayment is just covering the interest. So 31% actually goes towards dropping the present value down, and that's evident in the graph as well. If you look at the graph, you can see the graph is kind of level at the start, but then it drops off and becomes more vertical later on. Okay, that'll do for now. I'll come back and do another video, probably looking at task 3, I think. If I get time, maybe task 2 as well. Thank you.